I've seen in your notes that in terms of the yen, you've got that for the next 12 months it could go to 130, even to 120. How do you think that affects the earnings outlook for exporters going forward?
I think it will have an impact on the earnings of exporters. However, a lot of that impact is actually in terms of translating their profits from overseas. If you look at a lot of the Japanese manufacturers, whether it's automotive companies, electronic companies, they actually manufacture outside of Japan. So, it's core R&D and head office functions that are done from Japan. So the actual amount of yen in their overall cost base is smaller than you would normally expect from an exporter because of the overseas manufacturing. So it's not going to be a huge impact. I think in terms of, competitiveness, they remain competitive at 120, 132 yen to the dollar is very comfortable for them. So I don't think there's a big issue with the yen strengthening. Just a bit of translation gains will be given up.
And what about the story as it relates to corporate governance, right? Because we've seen, for example, particularly in the M&A space with that 7&I, really quite an audacious bid by ACT there as well. But how much more upside is there in that corporate governance story? Because whilst we are seeing change within Japan Inc., it has been slow, no?
The change has been slow, and if you look at the corporate governance reform journey, we're now into year 10 of that journey. It started in 2014 and then 2015 with the Stewardship Code and the Corporate Governance Code. And the way I describe it to people is that, if you climb Mount Fuji, you can drive up to the 5th station on Mount Fuji, and then from there you actually do the climb to the top. We're actually just at that 5th station. The institutional framework, the base camp has been set up, but the real heavy lifting in terms of corporate governance reform and the benefits to shareholders from corporate governance reform is yet to come. Why do I say that? Japanese balance sheets are still very bloated. 60% of Japanese companies are sitting on net cash, and that net cash is on average of over 20% of their balance sheet. They're sitting on lots of real estate, which is at book value from decades ago. It's not even marked to market. There are excessive amounts of real estate on their balance sheets. If you look at other non-core assets, they're still there. And then I recently did a study and analysis of the top 100 companies in Japan, and only 34 of those top 100 largest market cap companies in Japan actually do not have loss-making or low-margin business segments. So they still haven't fixed up their business portfolio. And, 7&I is an example of that. It's a company that's had a long series of fights with activist shareholders who've been pressuring them to exit multiple low-margin businesses and go to higher, focus on their core convenience store business, which is profitable. And so in Japan, if as even a very large company, if you are not efficiently using your assets, you can become a target for somebody who's going to make better use of your assets. And I think that's a huge message that we've had with this 7&I takeover bid. Nobody is safe in Japan because in a global context, they're small enough to be taken over. Even the biggest companies here are small enough to be taken over.